Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Anthony Cross, co-manager of the Liontrust UK Growth Fund, which features on our Wealth shortlist of funds selected for their performance potential. So Anthony, the fund invests in companies listed across the UK stock market, and you invest in companies with something you call an economic advantage. So could you tell us more about what you're actually looking for?
No, absolutely. I mean, this is a style that we've done for over 27 years now, and in many ways it might appeal to quite a lot of the type of people who invest with you in terms of the way that an entrepreneur might think about their business. Our view is that intangible assets, so intellectual capital is another word for it, have become really important in companies. And by that we mean often the assets in a business that you can't touch, but they do create very, very strong barriers to competition. And so we have three in particular that we look for before we would invest in a company. Any company we own must have a strength of either intellectual property, so patents, copyrights, trade secrets and know-how, or a very strong distribution network, which can be either a physical network that you might find with a company like Unilever or Diageo, or a much more modern data-driven network that you would find with a software company or a company like Rightmove, where that data is really embedded within the end customer. And we also like companies of high recurring income. By that we mean at least 70% of your income is recurring via subscription or fees. So that's our first gateway. Any company we own must have either IP or distribution or recurring income. Many will have all three of those, or perhaps two of those. But we're also interested in things like brands and customer relationships and culture. Our argument is that if you've got these sort of assets, you're going to have a barrier to competition, hopefully pricing power in most cases, and the ability to compound out growth over a long period of time. Now we then have a financial check for whether those barriers are working, and we take it from an independent database called Quest. And that looks at the cash flow returns on invested capital. So basically a more sophisticated return on invested capital measure. So when you start a business, you put capital into it. So what we're looking for is high returns on that invested capital. And with our UK Growth Fund, we have over twice the returns that you would find on average in the stock market. So we're getting you into value creating companies that then could hopefully achieve these excess returns that they can reinvest back into the business, and you get that lovely long-term compounding feature.
How are you investing the fund at the moment to take advantage of the opportunities on offer in the UK stock market?
So the style has always been deliberately what we'd call bottom up. So basically you look for really great companies and then build the portfolio out from there. It's also really long term. So the idea is to find these long term compounders that over a 5, 10, 15, 20 year period will deliver amazing share price growth. The real opportunities within the fund at the moment sit particularly within mid cap and small cap. So those are the sort of those businesses outside of the FTSE 100. They've become quite cheap in the UK market. And if you look at the fund, they're typically about 17% cheaper than they have been on average over the last 10 years if you look at their price earnings ratio. So what we think is exciting is particularly some of these mid-cap and small-cap companies where the valuations are depressed and they can then, in the future hopefully, regain valuation again, particularly because they've got these what we would call quality hallmarks that come out of our process. So high returns on capital, strong gross margins, strong operating margins, but they're cheap as well, which is fantastic.
And just picking up on valuations there, the UK is traded at a discount to its international peers for some time now, with lots of companies on deep discounts. So what needs to change to reverse that trend?
Flows. And by flows we mean money coming back into the market. And that's been particularly a problem in the kind of mid-cap, small-cap space. A lot of investors have been going more into global funds recently, or over the last few years. You know, they've done well in many ways out of quite a lot of the American businesses in particular. And it's left the UK somewhat neglected. And we've got amazing businesses within the UK. You know, we've got some of the world leaders sit within the UK market. You know, companies like RELX, companies like Sage Group, companies like Unilever. You know, these are big international businesses. And then beneath that, some amazing engineering businesses, some amazing software companies. So what we need to see is money coming back into the UK market. Now, what might drive that could well be a mixture of policy intervention. So in the old days when I started work, pension funds, big pension funds, used to invest a lot in the UK market. They've drifted away from doing that now, and we are well out of whack with our international comparators, in terms of the amount that the domestic pension funds invest within their domestic market. That can shift. The other big shift could be more in the kind of wealth management, the kind of retail, private client area, where people might see a change in the ISA regime, for example. Maybe in cash ISAs might get changed. There's hundreds of billions sitting in cash ISAs, and people are getting a tax advantage for doing that, which is mad in many ways. If you're going to get a tax advantage, you should be taking some risk, arguably, and you should be investing back into the UK economy. So tax policy should be more allied with economic policy. So it's flows, it's money coming back into the UK that is important. But we think the government have got that because the government needs to try and create economic growth. So we think the levers will start to be pulled, money comes back in, that demand and supply change increases the prices of shares, increases the performance of funds.
And you have a growth-focused investment approach. Investment styles go in and out of favour. When yours is out of favour, how difficult is it to stick to your knitting?
It can be emotionally difficult, but the important thing of having an investment process that we chatted about at the beginning is that it keeps you within these tram lines and it keeps you intellectually focused. You know what you're looking for and you can have big belief in those businesses and their ability to compound. We also have big belief in what our style footprint is. It is a quality style, and by that we mean high returns on invested capital, strong margins, strong balance sheet, solvency. And we know that that style happily works over extended periods. And it's worked very well in periods of interest rates that are similar to today. If you go before the financial crisis, so 1999, say up to 2008, it performed really well. The difficult time for a quality style, so these better businesses, tends to be when interest rates are rising. And that's because the way that people do discounted valuations of companies, and if interest rates are higher, then you will pay less for a growthy business. Once things tend to stabilise in interest rate terms, then the quality footprint that we have then tends to perform quite well again. So we've got huge confidence in owning quality businesses. And it really is. Investment sometimes gets overcomplicated by people in the sense that our job, as we see it, is to invest in great businesses and let them do the compounding work for you. And as we all know, that if you can achieve that compounding, the power of compounding is immense in terms of share price appreciation and therefore the knock-on impact on funds.
Reflecting on your career so far, what top investment tip have you picked up along the way that might have been useful to know back when you started?
Yeah, I would say the focus on the business model. When I started, and that was way back in the 1990s, 1990, I was an analyst at Schroders for 3 years and then I joined the smaller companies team. People seem to be very much focused on sort of dividend discount models or valuation as the kind of front end of what you're looking for. And there was never enough focus really on, okay, but what is the business model and how is that going to drive growth? How will it benefit from structural growth in the marketplace? And I think the focus should really be get the business model right, get the barriers to competition, understand the pricing power, understand the structural growth, and then sit with the business and don't get too excited about where the share price is going in the short term if you believe that that business will succeed over the 3, 5, 10, 15, 20 years. And we've got loads of examples in our funds that we've been running for a very long time of companies that I would call the quiet compounders. A company like Renishaw, that's not too far from here, is a lovely example of an engineering business that's just grown amazingly over the last 20, 30, 40 years. And if you look back to Renishaw when I started investing, it was a small cap company operating in only a few countries, and now it's a global business, a leader in its field, a really, really great example of long-term investing and long-term compounding.
And who would you say has had the biggest influence on your investment approach?
So, yeah, interesting. So I started with a guy called Andy Brough as my kind of line manager and a great tutor at Schroders. Lovely guy and passionate about small cap investing and also about the fun of investing, a real enthusiast for investing. So he had a big influence in terms of kind of the joy of investing and looking at small caps, what you can make out of small cap investing. Another big influence is a chap called Jeremy Lang, who I then worked with at Liontrust. I've only worked at two places. And he was very much more into business models, structural growth, drivers behind barriers to competition. So very disciplined in the way of thinking, and that was a powerful influence. And then I'm going to give you a cheesy answer to another one. Me. And I don't mean that remotely arrogantly. I mean that in terms of learning from your own mistakes. And I ran money at Liontrust from 1998 to 2008 by myself. And there's nothing beats that introspection, that learning from your mistakes, working out why that happened, what you could do about not letting that happen again, perhaps learning sometimes from your successes, but God, you learn so much from your failures that really sets you up, I think, for becoming a much better investor over time.
And outside of work, how do you switch off?
It's really important to switch off. It's a funny job, fund management, because there's no beginning, there's no middle, and there's no end. It's not project-based. You don't kind of wrap up for Christmas and think, oh, I've cleared my desk, fine. It just goes on and on and on. And it's also a competitive game in the sense that it's like being in the football tables. You're always being compared with something, an index, your peer group. You're compared quite often over quite a short period of time, which can be quite draining, particularly if the short period of time is quite tough. So it's really important to describe, to have a kind of hinterland, to have some things that you do that just take your mind away from it. So, I've always enjoyed fishing. I live out in the countryside. I enjoy, all the countryside pursuits of fishing and walking and planting trees and to the fresh air and dogs and horses. I've got a busy family life. There's quite, the children are brilliant, but also quite absorbing in terms of their activities. So I have a nice way of switching off, and it's important to get away from the noise of the market and just get some space and some time just to let your mind, what we call kind of at work, we talk about mulling things over, just letting things just gently flow through your mind and not getting into a kind of position where you're getting anxious and worried and silly about things. Just having space, having time, having contemplation time is really important.
Right. Anthony, thank you very much for joining us.
Thank you.